Your money-making broadcast starts now. Good evening, Canada. Today is June 4th, Thursday. Here are the top stories moving the markets. While the tech sector faced a sudden shock with Broadcom's plunge, the broader market showed incredible resilience, and we are seeing a significant rotation into value stocks that could benefit Canadian portfolios. Most importantly, all eyes are on Washington as we hit the D-Day for the new Fed chair's inauguration. The TSX showed steady performance, tracking the broader market while energy and financials led the charge in this value rotation environment. We will analyze why this shift is happening, how the Warsh effect will redefine the interest rate landscape for the Bank of Canada, and which specific TSX assets are best positioned to hedge against the volatility of the U.S. semiconductor sector. In a market where growth multiples are being questioned, the return to fundamental value is not just a trend, but a necessity for long-term capital preservation. We will dive deep into the Jarvis quantitative analysis to understand if this is a temporary dip or a structural regime change in how AI assets are priced. Furthermore, we will examine the specific correlation between U.S. Treasury yields and the TSX energy sector to provide a comprehensive roadmap for the coming quarter, ensuring your portfolio is not just surviving but thriving amidst the transition of power at the Federal Reserve. Before we dive into the big stories, let's look at the closing numbers. The S&P 500 finished at 7,584, up 0.41%. The Nasdaq closed at 26,831, down slightly by 0.09%. The Dow Jones surged 1.73% to 51,562, while the Russell 2000 climbed 1.51%. The VIX, our fear gauge, dropped 4.11% to 15.40, showing that the early morning panic has subsided. In other assets, gold rose 1.25% to $4,494 as safe haven demand persists. Looking at the ETFs, SPY closed at $757.09, QQQ at $740.61, and DIA at $516.70. The standout trend here is the clear rotation from growth to value, with the Dow and small caps significantly outperforming the tech-heavy Nasdaq. This divergence suggests that institutional investors are repositioning their portfolios to mitigate risk ahead of the Fed's leadership transition, favoring companies with tangible assets and consistent dividends over speculative AI growth. This shift is backed by a surge in inflows into value-oriented ETFs, indicating a broad-based movement of capital rather than a few isolated trades. Our first big story today focuses on the dramatic volatility in the semiconductor space and what it means for the Canadian investor. Broadcom, trading under the ticker Broadcom, saw a staggering 12.59% collapse today. On the surface, the numbers were record-breaking, with second quarter revenue hitting $22.2 billion, a 48% increase year-over-year, and AI-specific semiconductor revenue surging 143%. They even raised their full-year guidance to $56 billion. So why the crash? The market reacted sharply to concerns over gross margin mix. However, Jarvis analysis suggests this is an isolated event rather than a systemic AI failure. We saw Nvidia actually rebound by 1.82%, proving that the contagion was limited. For those of us tracking the TSX, this volatility reminds us of the importance of diversification. While U.S. tech swings wildly, Canadian energy and rail stocks often provide the necessary ballast. In fact, the legendary investor Stanley Druckenmiller reportedly exited his Broadcom position with a 12.4% gain at $487.12, a move that signals a shift toward capital preservation. This investor's decision to lock in profits suggests that the risk-reward ratio for high-flying chips has shifted. For Canadian investors, the lesson here is clear: don't chase the peak of a parabolic run when margin pressures begin to emerge, even in a high-growth AI environment. We must look at the underlying cash flows and avoid the trap of relying solely on revenue growth figures. To mitigate this risk, we recommend a strategy of staggered entries and strict stop-loss orders on high-beta semiconductor holdings to prevent catastrophic drawdowns during sudden sentiment shifts. Moving to our second major story, we are seeing a fascinating divergence in the U.S. indices that directly impacts our CAD-denominated strategies. While the Nasdaq struggled, closing down 0.09% at 26,831, the Dow Jones Industrial Average surged 1.73% to finish at 51,562. This is a textbook value rotation. Investors are moving away from high-multiple growth stocks and into stable, cash-flow-positive companies. We saw this reflected in the DIA ETF, which is now approaching its 52-week high. A key highlight here was the resilience of diversified software giants. This recovery was fueled by a massive $10 billion investment from Berkshire Hathaway into value-oriented sectors. While the crowd was obsessing over dilution risks in other tech giants, Warren Buffett's team saw value. This contrarian approach is exactly what we should be applying to the TSX right now. When the market panics over short-term headwinds, the real opportunities in Canadian financials and infrastructure often emerge. The VIX also dropped from 16.54 to 15.40, indicating that the initial panic from the Broadcom crash was quickly absorbed by buyers looking for value. This suggests a strong buy-the-dip mentality for companies with strong balance sheets, a strategy that historically favors the conservative nature of the Canadian market. We should specifically look at the price-to-earnings ratios of the Big Five banks, which currently trade at a significant discount compared to their historical averages, offering a margin of safety that is rare in the current U.S. tech-driven market. Finally, let's discuss the macroeconomic cliffhanger, the inauguration of Kevin Warsh as the Fed chair tomorrow. This is the single most important event for global markets right now. The market has already begun pricing in a Warsh effect. We are seeing a positive reaction in banking stocks, such as JP Morgan Chase rising 3.34%, as investors anticipate improved net interest margins. Conversely, interest rate-sensitive tech stocks are feeling the pressure. For Canada, the Bank of Canada typically follows the Fed's lead to maintain currency stability and manage inflation. If Warsh signals an aggressive stance on rates, the Canadian dollar could see strength against the US dollar, but our domestic borrowing costs may remain elevated. If he opts for a gradual approach, it provides a sigh of relief for the TSX, particularly for our highly leveraged energy and real estate sectors. Jarvis warns that we are currently on day 43 of a bull market, which is dangerously close to the historical average duration of 42 to 49 days. This suggests that the window for aggressive buying is closing, and a defensive posture, characterized by high cash reserves, is the most prudent strategy heading into tomorrow's announcement. We must consider the potential for a volatility spike if the new chair's rhetoric differs from market expectations, which could lead to a temporary liquidation of leveraged positions. This is why maintaining a liquidity ratio of at least 20% in cash or short-term T-bills is critical for the next 72 hours. Looking at sector performance, the Canadian financial sector stands to benefit from a steepening yield curve. Royal Bank of Canada and TD Bank are well positioned for a rising rate environment under the new Fed leadership. The TSX Energy Index also gained momentum as oil prices stabilized, providing additional diversification for Canadian portfolios. With the CAD potentially weakening against a hawkish Fed, export-oriented TSX companies could see increased competitiveness in the coming weeks. Furthermore, the industrial sector, led by rail and transport, is seeing a resurgence as global trade routes stabilize. This creates a multi-layered support system for the TSX, allowing it to decouple from the volatility of the Nasdaq. By focusing on these three pillars, financials, energy, and industrials, Canadian investors can build a portfolio that is not only resilient to U.S. tech shocks, but is actively positioned to profit from the global shift toward value investing. We must also monitor the impact of potential tariffs or trade policy shifts that could accompany a new U.S. administration's economic agenda, as these could either act as a headwind or a catalyst for Canadian resource exports depending on the specific agreements reached. To wrap up today's session, we've seen a market that can withstand a 12% drop in a semiconductor giant, provided there is a safe haven in value stocks. The rotation from growth to value is officially underway, and the upcoming Fed leadership change is the catalyst we've all been waiting for. Looking at our top picks for the Canadian and global investor, we have a diversified lineup. First, for a safe type play, the world's legendary value investor Benjamin Graham would choose Canadian Pacific Kansas City, CP.TO, at $124.37. This is a low volatility defensive play with a strong moat in North American logistics, and we recommend expanding the position if it hits $122. For a balanced type approach, the legendary growth and value hybrid Peter Lynch would choose a diversified tech leader with a strong enterprise AI moat and a massive cash pile, offering a blend of AI upside and fundamental value. We look for a buy entry after the Warsh announcement. For those seeking a growth type opportunity, the world's leading innovation fund manager Kathy would likely eye Cisco, CSCO, at $130. As the backbone of AI networking, Cisco provides the essential infrastructure that allows AI to scale, and it has already shown a strong 35.86% return in our tracking. Finally, for a low-cost or opportunistic entry, the global investment master John Templeton would suggest watching Broadcom, AVGO, at $418.91. While the drop was severe, a contrarian approach suggests a re-entry at $400 once the dust settles from the new Fed chair's first speech. Remember, the key is patience and strict risk management. For Canadian investors specifically, the Bank of Canada will be watching the Warsh transition closely. A more hawkish Fed could pressure the Canadian dollar, making our TSX-listed exports more competitive but potentially raising import costs. The TSX energy and rail sectors, including our CP.TO position, provide natural hedges against this uncertainty. Gold at $4,494 per ounce continues to attract safe haven flows, benefiting Canadian mining producers like Barrick and Agnico Eagle. With the TSX heavily weighted toward financials and energy, the the value rotation we are seeing on Wall Street could be a significant tailwind for Canadian portfolios in the coming weeks. For Canadian portfolios specifically, the TSX energy sector deserves attention here. With gold at $4,494 and the US dollar potentially weakening under a new Fed regime, commodity-linked Canadian stocks could benefit significantly. Our CP.TO holding at $124.37 with a 10.37% gain provides the rail infrastructure exposure that acts as an inflation hedge. The Bank of Canada will likely follow the Fed's lead, but Canadian banks enter this transition with stronger capital positions than their US counterparts. Fairfax Financial at $2,195.73 and CP.TO together form a solid Canadian value core in our portfolio. The TSX composite has historically performed well during value rotations, and the current Dow-led rally suggests this pattern is repeating. Keep your stops tight and your cash ready, the Warsh era is about to begin. The Canadian market has unique advantages in this rotation. Patience and discipline will reward those who wait for the Fed signal before committing new capital. Monitor crude oil and gold closely this week as the commodity-linked TSX sectors respond to the new Fed direction. Stay disciplined and wait for clarity before acting. Subscribe for daily Canadian market insights. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.